Well, it was a monster session for the stock market, fueled by a monster jobs report that underscores an economy on fire, but with enough room to grow that now cooler heads should guide the Federal Reserve's policy. Meanwhile, of course, the Dow still in that 2,000-point trading range I've been talking about, despite being up 441 points. As far as the session was concerned, industrial names were the second performing S&P sector, led by Dare and United Rentals, but it was the action in uniform maker Cintas that I think best represented the jobs report, which points to a return to glory for folks who work with their hands as well as their minds. By the way, also, I love the action in material names, perennial favorites, Sherwin-Williams, Rock, but check out potash maker Mosaic. Remember years ago when this was the hottest stock in the market? Starting to come back here. And then, of course, technology was all about semiconductors. They continue to rule. Now, I've mentioned them a few times in the last week on this show. They are absolutely crushing the shorts and now the record books. Remember, after collapsing from their peak in March of 2000, the Philadelphia Semiconductor Index needed 18 years to get back. Now it's off to the races. I'm just worried, though, that you aren't in this market. According to the American Association of Individual Investors, bearishness eclipsed bullishness over the past week. But it was the surge in folks claiming to be neutral that worries me. Now, listen, I really hope you aren't just cheering from the sidelines thinking that you don't have a right to be in this market, because this is your stock market. Now, the big question, of course, is how much room does this Goldilocks job market, the strong economy, have to go? Let's ask Lindsey Piegza, chief economist at Stifel Nicolaus. All right, I know you're going to tell me, Lindsey, to put the pom-poms down.
Well, no, to your point, it certainly was a fantastic report this morning. If we look at the top line number, over 300,000 new payrolls added. We had upward revisions to the January number, to the December number. So on the surface, this does look very positive. We also saw an increase in participation. So individuals that had previously been sitting on the sideline looked out to the labor market and said, well, conditions do look as if they're a little better. Maybe I'll jump back in and start looking for a new job, a new career. But that being said, my biggest concern is that lack of wage growth. We saw wages take a big step in the wrong direction from an annual pace of 2.8 to 2.6%. And remember, this comes against the backdrop of the Fed telling us that they expect inflation and wage pressures to gain momentum and push above their 2% target near term. So it really is a little something for everyone in this report, Lindsey, but it does still raise some red flags.
Can we get that inflation pressure without wages actually making a meaningful move?
Can we get the
Fed hit its inflation target? Yeah, without wages moving up. I mean, at some point, doesn't the anecdotal evidence point to perhaps a surge in wages at some point real soon?
Well, I think what you're getting at is, from a monetary policy standpoint, the biggest concern for the Fed in terms of inflation is a wage price spiral, right? The idea that the economy is overheating and businesses are absorbing that pool of available labor. And as a variable expressing that, we start to see wage pressures gain. So that really is the longer term signal to the Fed that they need to be more aggressive in reining in the economy and increasing interest rates. Okay, so despite the fact that some of the other metrics for inflation may be pushing closer to that 2%, they really want to see that momentum in the wage component.
Okay, and finally, I do want to ask, I looked at the New York GDP estimate and the Atlanta GDP estimate, and they dipped today. I was shocked. I thought they would both go up. 3%, the elusive 3%, is it possible? Is there a chance we can get there this year?
Well, now remember, we talked about fourth quarter GDP prior to the first round report, and everyone was saying 3.5%. We were on the much more pessimistic side, looking for 2.5%, and it did, in fact, underperform, coming in right around that 2.5% mark. And I think that's where we're going to be, with that being as good as it gets as we look out to 2018, 2019.
All right, Lindsey Piegza, thanks a lot. Have a great weekend.